Trump's announcement of the dismissal of Federal Reserve Governor Lisa Cook has triggered a triple legal, market, and institutional shock. First, this marks the first time in the Fed's one-year history that a president has attempted to remove a governor for cause, a move that is bound to trigger a court ruling and potentially even a Supreme Court appeal. Second, this incident occurred just as the Fed was leaving the door open for a September interest rate cut, raising concerns about political interference and heightening market concerns about central bank independence. Third, if the White House's influence over the Fed significantly increases, long-term US interest rates, inflation expectations, and the creditworthiness of the US dollar could face systemic challenges. The following will provide a comprehensive analysis of the background, legal framework, policy transmission, and market reactions to the incident, providing the public with an accessible, intuitive, and actionable framework. Why Trump is trying to fire Lisa Cook. The core of President Trump's attempt to dismiss Federal Reserve Governor Lisa Cook rests on allegations of mortgage fraud. Specifically, Trump claims that Cook, in 2021, listed two different properties as her primary residence on separate mortgage applications, which he called deceptive and potentially criminal. These accusations were brought to the Justice Department by Bill Pulte, the director of the Federal Housing Finance Agency (FHFA), who has been a vocal critic of the Federal Reserve and its current leadership. Cook, the first black woman appointed as a Fed governor, vehemently denies any wrongdoing and has stated she will sue to challenge her dismissal, emphasizing that the president has no authority to remove her. This situation is highly unusual because Federal Reserve governors are appointed for fixed terms and can only be removed for cause, typically interpreted as inefficiency, neglect of duty, or malfeasance in office. There is no historical precedent for a president attempting to fire a Fed governor on such grounds, making this a potential legal battle that could ultimately reach the Supreme Court. The argument from Cook's legal team is that Trump's stated reasons do not constitute cause related to her duties at the Fed. This move comes amidst a broader backdrop of President Trump's consistent pressure on the Federal Reserve to lower interest rates. Observers see this dismissal attempt as part of a strategy to exert greater control over the Fed's monetary policy decisions, ensuring appointees who align with his economic agenda are in key positions. What if Trump runs the Federal Reserve? The Federal Reserve is designed to operate independently from political influence to ensure its decisions are based solely on economic data and long-term stability, rather than short-term political cycles. This independence is considered crucial for maintaining public and market confidence. If President Trump's attempt to remove Lisa Cook is successful, and other sympathetic appointees fill vacancies, there is a risk that his nominees could gain a majority on the 7-person Board of Governors. This could significantly alter the direction of monetary policy. The concern among experts is that a politically influenced Fed might be compelled to implement policies, such as aggressive interest rate cuts, that serve political objectives rather than sound economic principles. Such a scenario poses several significant risks. Weakened inflation anchor. If the market perceives that the White House can dictate interest rate decisions, investors might anticipate interventional rate cuts. This could make long-term interest rates more sensitive to inflation and fiscal risks, potentially driving up nominal and real yields. In essence, it could lead to a situation where short-term rate cuts are offset by an increase in long-term rates, creating a stagflationary conflict where rates are cut but long-term borrowing costs still rise. Increased term premium. When central bank independence is compromised, investors typically demand a higher premium for holding long-term debt due to increased uncertainty. This means that even if short-term rates are lowered, the cost of long-term borrowing for businesses and consumers might not decrease as much, or could even rise, undermining the intended stimulative effects of rate cuts. Erosion of dollar and Treasury credibility. the U.S. dollar's status as the global reserve currency and U.S. Treasury bonds as a benchmark asset are underpinned by institutional trust, including the Fed's independence. If this trust is eroded by political interference, it could lead to a decline in foreign demand for U.S. debt, increasing refinancing costs and potentially tightening overall financial conditions. Historically, the U.S. has achieved periods of prosperity and stability partly due to the Fed's ability to make counter-cyclical monetary policy decisions, free from electoral pressures. Undermining this independence could lead to short-term economic boosts at the expense of long-term stability and significant economic costs. Would cutting interest rates now be beneficial or harmful? The question of whether to cut interest rates now is a complex one, with the Federal Reserve currently navigating a delicate balance. The federal funds rate remains in the range of 4.25% to 4.5%. Recent data shows a pronounced slowing in job creation and some signs of softening consumer spending. While the economic outlook remains uncertain, there's also concern about lingering inflationary pressures, particularly from tariffs, which may still transmit their costs to consumers over time. Immediate benefits of rate cuts. Cutting interest rates generally makes borrowing cheaper across the economy, which can stimulate growth. Reduced financing costs for consumers. A rate cut leads to a reduction in interest rates on various consumer loans, including credit cards with variable rates and adjustable rate mortgages (ARMs). This eases the financial burden on households, potentially freeing up more disposable income. For instance, credit card interest rates, which are often tied to the prime rate, would likely see a direct reduction, making revolving debt less expensive. Fixed-rate mortgages, however, are generally unaffected unless individuals refinance, but new fixed-rate mortgages could see lower long-term rates if broader bond yields decline. Stimulated business investment and hiring. Lower borrowing costs encourage businesses to take out loans for investment, expansion, and hiring, thereby fostering economic growth and job creation. Boost to stock prices. Lower interest rates often make stocks more attractive relative to fixed income alternatives, leading to increased risk appetite and potentially higher stock valuations. Global spillover effects. Lower U.S. interest rates can alleviate financing pressures in emerging markets and reduce global risk premiums, contributing to more stable external demand and global financial conditions. Major concerns of rate cuts. Despite these potential benefits, several significant risks are associated with cutting rates prematurely or too aggressively. Inflation rebound risk. If tariffs continue to feed into consumer prices and monetary policy is simultaneously eased, it could fuel sticky inflation, particularly in services. This might force the Fed to reverse course with rate hikes later at a higher economic cost. Term premium dilemma. If markets doubt the Fed's independence, long-term interest rates might paradoxically rise even as short-term rates fall. This yield curve inversion or steepening could mean that despite the Fed cutting rates, long-term borrowing costs for housing and long-term investments might not decrease as expected, effectively undermining the policy's intent. Policy space and credibility. Initiating a deep easing cycle in an environment that is not clearly recessionary could leave the Fed with insufficient policy tools to respond effectively to future economic shocks, undermining its credibility. For consumers and businesses, the impact of a rate cut can vary significantly. Credit cards and variable rate loans. Interest rates on credit cards and variable rate loans like home equity lines of credit (HELOCs) are often tied to the prime rate, which closely follows the federal funds rate. A rate cut would likely lead to lower monthly payments for these types of debts, providing immediate relief. Fixed-rate mortgages. Existing fixed-rate mortgage payments would remain unchanged. However, if broader long-term yields decline in response to a rate cut, new fixed-rate mortgage rates could become more attractive, potentially stimulating the housing market for new buyers or those looking to refinance. Savings and money market accounts. consumers typically earn less interest on their savings when the Fed cuts rates, as banks adjust deposit rates downward. While money market funds might also see lower returns, the impact can vary depending on the fund's underlying investments. Stock market, lower rates generally make borrowing cheaper for companies and can boost corporate earnings, which is often positive for stock prices. However, as mentioned, concerns about Fed independence or inflation could complicate this effect. Bond market, short-term bond yields tend to fall with rate cuts, but the behavior of long-term bond yields is more complex, influenced by inflation expectations and the perceived independence of the central bank. Small business financing, while borrowing costs may generally decrease, the actual impact on small businesses can vary based on their creditworthiness and the lending policies of individual banks. The next Federal Open Market Committee FOMC meeting is in September. Prior to that, 2 more inflation reports and 2 more employment reports will be released, providing crucial data for the Fed's decision-making process. Jerome Powell, the current Fed chair, has signaled that conditions may warrant adjusting our policy stance, usually interpreted as a move toward rate cuts. But he continues to emphasize a data-dependent approach and a careful balancing of risks to inflation and employment. This unfolding situation surrounding Lisa Cook and the Federal Reserve is far more than a political spat. It's a critical juncture for the U.S. financial system. First, the attempt to dismiss Governor Cook on grounds of mortgage fraud, while not yet legally settled, represents an unprecedented challenge to the Fed's long-held independence. The resolution of this legal battle, potentially by the Supreme Court, will set a significant precedent for the future autonomy of the central bank. Second, the prospect of a politically influenced Federal Reserve raises serious concerns about economic stability. Should a president gain direct control over monetary policy, it risks introducing boom and bust cycles, higher inflation, and a fundamental erosion of trust in the dollar and U.S. Treasury bonds globally. Finally, the debate over interest rate cuts highlights the complex balancing act the Fed faces. While lower rates could provide a welcome stimulus to a slowing economy, the risk of reigniting inflation, particularly with ongoing tariff uncertainties, is a substantial concern. The ultimate benefit or harm of a rate cut hinges not just on the economic data, but crucially on the unwavering perception of the Federal Reserve's independence. Thank you for joining us for this in-depth look at these critical issues. We will continue to monitor these developments closely.